Thank you very much. Welcome everyone. It's a pleasure to be here for the very first time in Wrocław. Very beautiful city. I was really surprised yesterday when we arrived. I didn't expect it like this. Very nice place. Yes, so let's talk about cryptocurrency trading using Java. I'm Andy Flury. I'm a founder and CEO of AlgoTrader. Before that, I was a partner at a hedge fund in Switzerland, so I've been in trading for quite a long time. And then we started AlgoTrader. I have a Master's of Science and an MBA. Yes, so who are we? AlgoTrader. We started in 2014. AlgoTrader is a software for quantitative hedge funds and cryptocurrency trading companies that allows them to automate their trading strategies. So basically the platform allows automation of very complex trading strategies. It supports equities, so stocks trading, forex trading, futures and options trading. And for about a year now, we also support automated trading of cryptocurrencies. It's a Java-based product. It's an event-based system and has quite a modern stack using Java, Spring, Hibernate. We have ActiveMQ. We have a HTML5 based UI using React and Node. And we are using Docker for server-side deployments. So this is what the product looks like. This is the trading UI, the live trading management UI for the system. So it's a typical trading screen that some of you might have seen from banks. Here is a bit of an architectural overview. So what you see here in the middle, this is the AlgoTrader server. And then on top you have the automated trading strategy. So this is the decision making where all the trading logic happens. In here in the AlgoTrader server we have these, we call them business services. So these are services that hedge funds typically use in their trading. Over here on the left-hand side, we have a lot of inbound data adapters for live market data, for historical data. So we connect to Bloomberg and TT and various cryptocurrency data sources. Overall, we have about 30 adapters that we developed over the years. Here on the right-hand side, we have the outgoing adapters mainly for placing orders to the exchanges or to brokers. But also the system can send email and text messages and so forth. And we have a public API using REST and WebSocket. Yeah, so just that you have a bit of an idea how our system looks like. So about our business, we are actually a small startup, but we have clients all over the globe. So we're originally from Switzerland, but Switzerland only accounts for about 10%. We have quite a few clients in Europe, but about 40% is in the US. So this is the biggest market. This is also where lots of hedge funds are located. There are lots of cryptocurrency hedge funds starting up. So this is a big market. And as mentioned, we're mostly working for hedge funds and prop trading companies. So prop trading companies, I don't know if you know the difference, those are companies that trade their own money, and hedge funds are actually trading other people's money. So this is our team here, very global team. We actually have 3 guys here from the Wrocław office. We have Kuba, please get up. Kuba, and we have Marek, where is he? There he is. And Anna. Yes, so a few facts about our company. We have built about 100 trading strategies over the years. So we work for many hedge funds, and we build various trading strategy, so we have a lot of experience in this field. We have offices in 3 countries, so we have Zurich, we have Wrocław, but we also have a sales team in New York. And we have, actually very proud of this, we have 10 different nationalities in our team, even though our team is only 15 people. And we have some outside investors in our company, including a venture capital fund from Silicon Valley. We have about 80 clients, and our software is about 200,000 lines of code, so it's not too big. So let's then talk about the main topic about cryptocurrencies. But before that, I would like to ask a few questions. Who in here has ever bought Bitcoin? Please hold up your hand. Or other cryptocurrencies. So there is more on this side. So here is all the Bitcoin traders, and there is all the other traders, right? Good. And so out of these people who have bought Bitcoin or other cryptocurrencies, who has like actively traded and tried to make some money on the side? One? Okay. So, and is there somebody who has experimented with cryptocurrency APIs, maybe tried to place orders automatically using a program? One. Okay. Two.
I'm not
Good.
counting, right?
You?
I do not count.
I don't know. Do you count? Do you?
The context.
Okay. So about 3. Good. Very good. Yes, so I will do a quick introduction just on these topics. Don't worry, I'm not going too much into the details. So what is cryptocurrency? It's basically a digital asset, a distributed digital asset that heavily uses cryptography. So it's distributed and it's not controlled by a single entity, so not by any government or something like that. And cryptocurrencies are stored on a blockchain. I'm sure everybody knows about that. So what is a blockchain? So basically a blockchain is an open distributed database, so also sometimes called a distributed ledger that holds transactions. So this blockchain, this list of transactions is continuously growing, and it's irreversible. So once a transaction makes it into the blockchain, it stays there forever. It's visible to the whole world. So whenever you buy or sell cryptocurrency, that transaction will be visible to everybody. Obviously not with your name or email address or anything like that, but nevertheless it's visible. So each transaction is actually linked to the previous one using cryptography. It's resistant to modification, so once it's there, it stays forever. And a transaction becomes generally accepted when it has been confirmed by multiple nodes. So the blockchain, the Bitcoin blockchain, for example, has thousands of servers around the globe, and when a certain number of Bitcoin nodes confirm a certain transaction, then it becomes accepted. And that term is called consensus. You might have heard of that term before. So then next one, mining. What is mining? Mining is the creation of cryptocurrencies. And this is actually done by solving complicated mathematical problems. And when a problem is solved, a new block on the blockchain is created. And the miner who has solved the problem, as a reward, gets a certain number of cryptocurrency or Bitcoin. So the miner creates new blocks, and he then has the authority to decide which transaction is included in this block. And that's actually quite interesting. So when you send somebody some Bitcoin, you offer a certain fee for that transaction, and you actually decide what fee you want to add to that transaction. And this fee is offered to miners. So miners can choose which transaction they want to include in their block, and then that happens. And in times when there are a lot of transactions, the result is that if you add a transaction fee that's too small, you might have to wait for a very long time. In December 2017, the average transaction fee was like $40 or $50, whereas normally or before that it was like a few cents. And if you didn't add that fee, you would have to wait very long. So the last one here on this slide is a wallet. So what is a wallet? So a wallet is used to send and receive cryptocurrency. And basically a wallet stores the public key and the private key. I mentioned that this has a lot to do with cryptography. So the wallet actually stores the keys. Sometimes people think that a wallet actually stores the coins, but that's not true. The coins are on the blockchain, and the wallet only holds the public and private key. Now, the problem with storing these keys is that if you lose your private key, the coins are gone forever. There's absolutely no way to recover your coins. So, and this is a huge problem for cryptocurrency funds. I was in New York 2 weeks ago, and I met with a pretty large cryptocurrency fund with like 200 employees, and they manage millions of dollars in Bitcoin, and they store it on a little wallet and put it in a safe. And they actually have people with guns in the office to make sure that nobody steals their devices with the wallets on it. It's crazy. We're in the age of digitalization, and people protect their assets with guns. So next topic, cryptocurrency exchanges. So what does the market look like? So this is a very new sector. And it's very fragmented. There are about 200 cryptocurrency exchanges around the globe, and there are many participants, typically very new companies. There is a lot of startups in this space. Cryptocurrency trading is typically not regulated, so it's very easy to start an exchange, to start a trading company. Also, that means that support is typically quite bad. If you have an issue with an exchange and you contact their support, it might take days or weeks until you get an answer. So what is a cryptocurrency exchange? So those are essentially businesses that allow you to exchange one cryptocurrency against another one, or to exchange a cryptocurrency against regular fiat money like US dollar or euros. And these exchanges operate on commission. So every time you do a trade, you have to pay them a little commission. Most of these exchanges don't operate in Western countries, but try to set up their operations in some third world country to avoid regulatory oversight. So these are typically private companies, private startups. So even though they are named exchanges, you cannot compare them to big traditional exchanges like the New York Stock Exchange or the NASDAQ. So what are your options when trading cryptocurrencies? Obviously, you can open an account at an exchange or multiple exchanges, and that might be very simple, like the Binance exchange, for example. You can open an account and start trading within a few minutes. Others have a very lengthy process and sometimes takes weeks until you can start trading. So what's special about cryptocurrency trading is that you can only start trading when you actually have some assets or some coins on the exchange. This is different with stocks trading. For example, where you just have a bank account with a bank or a broker, and then you can start trading. And because you are storing or you are depositing coins with the exchange, there is a certain risk that if an exchange goes bust, your coins are gone. We had that a few years ago with the Mt. Gox exchange in the United States that went bust and all the coins were lost. Another alternative is to use a broker, a cryptocurrency broker, or OTC dealer. OTC stands for over the counter. So these are companies that help predominantly cryptocurrency funds to place large orders. If you're a fund and let's say you want to buy Bitcoin worth $10 million, you cannot just go to an exchange and place an order for $10 million. The price would just run away and you would pay way too much. And the broker actually can do that. So a broker will help you execute large orders. So what are the opportunities and risks in this market? So it's a very fragmented market. I mentioned that it's highly volatile. Price differences are huge, but this also bears a huge potential for trading companies because there is a lot of volatility in the space. It's a very immature market, so storage of cryptocurrencies is a problem. If you lose your coin, if you lose your key, coins are lost forever. And a lot of the technology that we see today is not properly tested. So there are a lot of technical issues. Typical issues we see is, for example, that exchanges are overloaded. We have one guy in our team, Robert, who has just finished the integration of the BitMEX exchange. And last week he kept getting exchange overload messages. There's nothing you can do. You just have to wait and try again a little later. Then there are often problems with deposits and withdrawals. So let's say you have your coins on the exchange and you want to get it back. Often, especially for US dollar or euros, it might take several days or even weeks until you have your money again. And then there is little or no regulation. So it's quite easy to set up a new crypto company, an exchange, but probably this will change. Multiple countries are now introducing new regulatory, so we'll probably see some change in this space. So let's then talk a bit more about some of these technologies, some of these APIs. So when we talk about a cryptocurrency API, what type of APIs are there actually? So obviously the most important one is market data and prices. So a lot of these exchanges offer WebSocket APIs that stream live market data to you. Then we have historical data. So obviously when you want to run automated strategies, you want to use historical data. You want to maybe do some simulations. Then obviously placement of orders. You want to be able to place an order automatically through the API. And then we have account data, so that's basically balances. How much coins do I have on the exchange? How much USD do I have on the exchange? And so forth. And then we have reference data, which I'm not going to mention here. So what type of technologies are used? It's basically these three. So we have REST, WebSocket, and the FIX protocol. I'm pretty sure all of you know REST, so I'm not going to go into the details. So request response based protocol works great. It's known all over the globe. WebSocket, a push-based protocol is also heavily used by exchanges. For trading, REST protocol by itself is actually not ideal because it's a request response. You don't get notified automatically. So let's say you place an order and you want to know if that order gets executed. You have to continuously poll the exchange and ask, is my order executed? Whereas if you have a WebSocket API, you actually get a notification. You know, your order was executed. So, and we have actually integrated quite a few cryptocurrency exchanges in the last 12 months. And we noticed that even if they're using WebSocket, we see a lot of variation. So either they're using standard WebSockets or like a socket cluster or PopNup or other variations. So there is no standard yet. Every exchange does it different. And then there is a fixed protocol, and the fixed protocol is actually a pure trading protocol. So the fixed protocol knows about what is an order, knows about what is a quote, what is a trade. And this is different from REST and WebSocket. You know, those are domain agnostic protocols. You could build a hotel reservation with a REST protocol. With Fix, that's not possible. Fix is always trading. So. And the problem is that in the cryptocurrency space, unfortunately, Fix is not used very often. Most of the exchanges use REST and WebSocket. So what does that mean? So to integrate an exchange is actually much more work than to integrate a bank or a broker through the Fix protocol. So from experience, it typically takes us about 2 or 3 days to integrate a big bank or a broker, but for a crypto exchange, it's anywhere from 2 weeks to a month. And then there is another option. So in addition to connecting to exchanges directly, you can also use intermediaries. And there are quite a few you can choose from. So there is Coinigy, there is Coin API. So these intermediaries, they allow you to connect to multiple exchanges at the same time, which sounds great. You know, it makes your life easier, but you know, you're also adding an additional component to the system, an additional layer that might potentially fail. And we actually had to learn this ourselves. We integrated Coinigy that connects to about 45 exchanges. It turns out, yeah, it sounds nice on the paper, but there is a lot of issues, so it was not a very good experience. And this was also the reason why we started adding direct exchange connections. All right, so let's then talk about automated trading of cryptocurrencies. Can use for that. So there's libraries like TALib or TA4J that allow you to try out various libraries and then just, you know, see what works. So a lot of people use those libraries. They do back tests with historical data and then figure out what works. So basically what you're doing with these technical indicators, you are trying to identify a trend. So basically what the gentleman in the back said, and then trying to profit from that trend. And then there's the other one, and that's basically what Radek mentioned. It's arbitrage trading, and this is very popular in cryptocurrency trading. So basically you are taking advantage of price differences between two exchanges. So you try to buy at a lower price and try to sell at the same time at a higher price at another exchange. And this is possible because there are so many exchanges and price differences are sometimes very huge. They are becoming less because so many people are actually doing arbitrage trading. And then there is market making. Market making is maybe the least well known out of these three. So what does a market maker do? A market maker places continuous buy and sell orders around the current price and hoping that people will buy from him and sell to him again. So every time this happens, he makes a small profit. Obviously, the tricky part with market making is that you have to know what is the fair value, and nobody tells you that. You have to have your own model of calculating the fair value, where you place buy and sell orders around. So, so the fair value is a tricky part, and the other tricky part with market making is the risk management. If the market moves against you and suddenly you are selling much more than you are buying, then you're suddenly becoming very exposed to the market, and you're obviously always on the wrong side of the market. So, and this is called risk management. This is also a set of rules that defines what should the system do if you're either too much long or too much short. So these are the three basic types of trading, not just for cryptocurrencies, but for any asset that can be traded. Then there is another topic on here that I also like to mention, backtesting. So very often when you trade a trading strategy, a quantitative trading strategy, you want to do backtesting. So you would like to know, how would my strategy have performed in the past? And for this, you would use historical data that you can purchase from various sources. So in cryptocurrency space, there is, for example, Coin API or Coinigy, where you can buy historical data, and then you can use your trading system and see how that would have performed. Ideally, you would want to use the same code for backtesting and for live trading. So you run your test with historical data. Every strategy always has a set of parameters. So you would run a back test, see how that would have performed, then maybe change the parameter slightly, see how it would have performed, and you're basically optimizing your parameters. And this is what backtesting is. So you run many back tests. You try to figure out what is the best range of parameters for my strategy. Obviously, the size and the amount of historical data you have has a huge impact on how long your backtest is. A backtest might take a few seconds, or it might take several hours, depending on the size of data. So that's cryptocurrency trading strategies. Let's then look at an example. So what you do very often, you aggregate live trades into bars or candles. So that's an aggregation and basically a summary. Let's look at this one here. A summary, what might have happened in 10 seconds. So this symbol here represents the opening price during those 10 seconds, the closing price, the minimum, and the maximum. So every 10 seconds you create one of these bars or candles, what they're called, and that makes it very much easier to trade. So very often you would first transform your live data into bar data. Good. So live demo. So what does the strategy do that I'll show you? It first receives market data from the Bitfinex exchange, which is a very popular exchange, through a WebSocket API. Then it'll do this aggregation from live data into open, high, low, close bars on a 10-second period. And then the next step is to use the TA4J library to do the exponential moving average calculation. And then the last one is to place orders via Bitfinex REST API. So you actually, if we're lucky, we'll see some live trades on the Bitfinex exchange. The strategy is actually available on GitHub. You can download it there. You can play with it. Hopefully make millions of dollars with it. So to actually show you what that looks like, so this is, if you go to the Bitfinex, the whole API is on their webpage, and we are right now looking at the trades WebSocket channel. So over this channel, I'm getting messages like this. So they contain a timestamp and a price. So the price, the last traded price, and the quantity that was executed. So this is actually what we're receiving, and we will parse this information here into a trade event. So a trade event basically captures these elements we're receiving here through the WebSocket API. And then once this parsing is done, so we now have an object that contains the information about the last trade that took place on the exchange, and that then is handed over to my strategy logic. And this is actually, I'm going to spend a little bit more time here on this class. This is the class that implements the actual trading logic from my strategy. So what do we have here? We've got some initialization at the top here, so some properties that are actually injected here from a properties file. Then here in the after properties set method, this is when the Spring context is initialized. These objects here are instantiated. So the first one we have is the base time series. So this actually represents the list of open, high, low, close bars. So this object here, the base time series, is basically a collection. Could say that. And then we create a close price indicator, which is based on the base time series. So the base time series contains open, high, low, close, and the close price indicator is just a collection of closing prices. So just the last one. And then we create these two exponential moving average indicators that we've seen here in this chart. So we create a short exponential moving average with a look back period that is from the properties file of 5 periods, and we create another exponential moving average with a look back period of 10. And then the last one is the difference of these two. So the difference indicator will basically be 0 when we have a crossing, and when the two exponential moving averages grow apart, then the difference will be either positive or negative. So we have the base time series, the close price indicator, the two exponential moving averages, and the difference. And these 5 collections, they are updated on the fly by the library. So I don't have to do that manually. So in the market data service, we had this strategy logic handle trade event. So every time we receive a trade event, that event is handed to my base series, and through the base series it's then propagated to the other indicators that are daisy chained to it. So every time there is a live trade coming in, that will be added to the base series. And then I mentioned the 10 seconds logic here, that we are aggregating 10-second bars. And this is actually something that the TA for J library is not doing automatically. So I have to do that myself. So here I added a Spring Framework scheduled annotation with a cron job definition. So this on time method here gets called every 10 seconds. That's actually this notation here I'm sure you're all familiar with. So every 10 seconds we are first printing out the information about the current bar. We are evaluating the strategy logic, and we are starting a new bar every 10 seconds. So I won't go into the log bar method. That's just logging, not very interesting. But we'll look at the evaluate logic. So this method here, this is really where the trading logic happens. So We are looking at the EMA difference. So as you remember, that's the indicator that captures the difference between the two exponential moving averages. We're looking at the current difference, so the EMA diff, that's the current difference, and the EMA diff previous, that's the one 10 seconds ago. So we know what is the difference now, we know what is the difference 10 seconds ago. And then here is the actual trading logic. So if we have a difference that is positive, but the previous one was negative or zero. So if we have something like this, so the difference was negative, and then it crosses and now it's positive. In that case, we buy. We send a buy order. I'll show you the trading service. In the opposite case, so if the difference is negative and it was previously positive, so we have a crossing to below, then we sell. That's the logic. That's the whole logic. So if something is wrong here, you'll lose millions, and if this is good, then you'll make millions.
Okay.
No, not with this strategy. That's too simple. So the last piece is the trading service. So this is the part that uses the Bitfinex REST API. So basically here with these three lines, we are creating an object, a Java object that represents an order. So we basically set the symbol, so Bitcoin USD, we set an order amount, side is buy or sell, we set the price and so forth. And then we create a request entity so that we can do a REST post, and then we're using the REST template to actually send out the request. There is a bit more code down here. The issue with the Bitfinex REST API is that when you're sending an order, it requires you to sign the request. So there is quite a bit of encryption code down here. I'm not going to go into the details. If you're interested, you can just download it from GitHub and have a look at it yourself. So that's it. That's the entire trading strategy. So quick summary here. We're receiving market data via WebSocket. We're doing the 10-second bar aggregation, and we're using TALib to calculate the exponential moving average indicators, and we're sending orders via REST. So let's see if that actually works. So you see it's a Spring Boot application. Starts up, that's good. And after 10 seconds, so when we're at 1859, we should see a first bar. Yes, okay, here we go. So now you see that every 10 seconds it creates or prints out this bar information here. So it prints out what was the opening price, what was the high price during these 10 seconds, the low price, the closing price, what was the traded volume, so how many Bitcoin were traded during these 10 seconds, and how many trades. So the strategy is looking for, as you remember, the 5-period exponential moving average and the 10-period. So we actually have to wait for 10 bars until the strategy logic becomes active. Yeah. Okay, so now we actually have reached the 10th bar, and now it, in addition to the information we had previously, we also see the difference. So we see the current difference is 1.2, so the difference between the two exponential moving average and the previous one. So at the moment it's actually falling. It started around 1 and now it's at 0.8. So now we just have to wait until we have the first order. That might take a while. We'll come back and see if there have been any trades. In the meantime, I'll open up. This is my Bitfinex account. So you actually see here all the orders I've traded. So I've done quite a bit of testing this afternoon. So, and if we're lucky, actually the strategy will place orders that we can see here. In the meantime, before we actually see a trend, I would like to, so this trading strategy here is pure Java, just Spring and TA for J, so you don't actually need a trading product for that. But I would also like to show you what that would look like if you use a product like AlgoTrader. So I have a second strategy here, the EMA strategy, that is based on our own product, AlgoTrader. So it looks like we are getting very close here, but no trade yet. So the advantage of using a trading product is obviously that you don't have to deal with all the boilerplate code. So you don't have to add your own exchange adapters and so forth. So the code of the strategy actually becomes much simpler. You still have to implement these 4 indicators like we did before, and you still have the trading logic here, similar to what we had before, but that's it. All the rest is done by the framework, and that just makes your life easier. Also, another advantage is that you can now, with a framework like this, you can run a backtest. So you can try and see how that strategy would have performed historically. And actually, we have a trade. So it's as simple as that. And all you need is an account on one of these exchanges. The good thing is that you can even start with like, you know, €100 or $100. So they allow you to place very, very tiny orders. I think on Bitfinex the smallest one is 0.02 Bitcoin, which is about $20. So you don't have to be a millionaire to try it out.
My name is Roger Lang. I'm the head of projects at AlgoTrader, and don't worry, I won't keep you from beer and pizza for long. I just want to give you some insight on how these trading strategies are implemented in the professional world. So it all starts with a hypothesis. So some client has an idea of how he wants to trade, and then he comes to us with that idea, and then we do the analysis, which is basically working on the specifications and getting the idea into a state where we think we can implement it properly and where the client thinks it does what he wants. And then we implement it and hand it over to the client, and then the client can do some testing. So in a full cycle, it would usually look like that the client starts some back testing using historical data. That means validating whether the idea is actually profitable, at least looking at previous market developments, and potentially also optimizing the parameters. So as Andy mentioned, the challenges here is that you can potentially have huge amounts of data, so performance is a key element in this thing, and memory is a key element in this thing as well. And you know, you can spend a whole evening about backtesting, so I'm not going to go too much into detail here. When the, let's say, calibration of the algorithm is finished and the client is happy that it has a performance that he can live with, then he would start testing versus the live market. Now, in cryptocurrencies, this is not really possible, but in other markets, you would have the possibility to do paper trading, and that means that brokers allow you to open an account at them, and then you can set a flag that's saying, I don't really want to trade, but I want to use your software as if I were trading. And then the client would get order execution messages back and order cancellations and all these things. And in our product, then he could see the performance of his strategy without actually participating into the with the market. But you would actually be trading against the market, so against the live market developments as they happen. So it's a bit better than backtesting because this shows what is happening today. And once he's happy with that, then you would go into live trading. So just some examples of the kind of strategies that we have implemented in the past. We've got two large crypto brokers in Switzerland. I think one of them has a trading volume of roughly $500 million US per month. And in these cases, it's mostly about execution algos. So breaking down large orders into smaller ones so that the market isn't aware that you're actually trying to sell or buy these big positions. And we can automate that. And then there are, of course, traditional market strategies. So many hedge funds work more medium and long term with medium and long term trends. I mean, we've had a client here that had about 200 future exchanges linked up to his strategy. So they can be very, very different, the type of strategies that we do. Interesting one, this one here, the initial public offering one, with a client that wanted to buy stocks on the first day that they were made public and try to make money on that. And that's, interestingly enough, so the type of strategy we do here can be very different and also in very different markets. So in case you found any of this interesting that you heard today, there's good news. We're hiring people at the moment, so our partner in Wrocław is Ciklum, and anyway, after this presentation you can grab Andy or myself and have a chat if you're interested in these kind of things. And just to give you a rough idea of what that means, so if you're working at our company, so well, on the one hand we build the trading strategies, as we have seen extensively today, and of course we have the whole platform behind it. So we need to make sure that we get the connections to the exchanges. We need to make sure that the platform is performant, so in terms of the volumes that go through there and the speed that it needs to be executed at. And so there's a lot of work on the platform side as well that we do in this space. A couple of sentences on this one. We work in an agile environment, so we use Scrum as a development methodology, and we don't plan ahead 2 years in advance, so we have a rough roadmap, but we're fairly agile in the way we address these things. So if there's a bigger piece of work, we do some investigation on that, we get together again, work out how to work from that, and basically develop the platform iteratively.